Hi, it's Darren Fisk with Forum. Thanks so much for joining us this morning. We're excited to have you with us today for the conversation with Willy Walker. So Willy's been instrumental both on the business front for me personally, as well as Forum and a big provider of debt over the years for us. So I'd like to turn it over to Willy and give him a chance, because most of you know Walker and Dunlop, but for those of you who don't or know Willy, I'd love to let him give an introduction on himself and his company.
So Darren, it's great to be with you today, and I actually had to put this call in between a number of other things, including physical therapy on my leg, which, as you know, I had surgery on my leg a little while ago, and so I'm sitting outside of my physical therapy center right now, and found a really great spot, except I've got I-25 right behind me, and I've got Centennial Airport on the other side. So you might hear some planes coming in over my head. Let's see, W&D, publicly traded, New York Stock Exchange, WD is the ticker, commercial real estate finance company. In the last 12 months, we've done $32 billion of commercial real estate financing. In the last 12 months, we've done just under $6 billion of commercial real estate investment sales. In both our investment sales business, as well as in our financing business, the majority of what we do is in multifamily. On investment sales, that's all we do. We do not sell any other asset class other than multifamily. In our financing business, our typical mix is sort of 85% multi and 15% other commercial real estate asset classes. And while 15% is obviously a much smaller percentage of our business, given that we're doing $32 billion of financing in the last 12 months, we still do a very significant amount of office, hospitality, and retail financing. Our servicing portfolio today is over $100 billion of loans. We are the largest Fannie Mae servicer in the country. We're the sixth largest servicer of commercial real estate loans in the United States today. And so I think one of the reasons, Darren, you wanted to have a conversation was just that, we're seeing a lot right now. We're seeing a lot on the loan origination side. We're seeing a lot on the investment sales side. We're seeing a lot on the servicing side as it relates to how our portfolio is performing. And so I might be able to provide some thoughts and ideas to your audience as it relates to what we're seeing in the markets today and what people are actually doing today and what we're thinking about people might be doing tomorrow.
Well, I appreciate it. Obviously, it's your job and mine, both from a macro level as well as micro, just to understand not only the global and U.S. economy and the effects on it, on everything going on, but also, as you mentioned, in the multifamily world, both macro and micro. One of the things that you have that we don't is obviously the insight into how your loan servicing portfolio is doing, or cap rates are going because of your brokerage business, and all the way into sub-markets within micro markets. So really appreciate you taking the time and giving us the insight. Just a few things I'd like to dig into today. You've obviously had a large presence in multifamily for a long time. What is it that you really like about the multifamily business, both acquisition, financing? You guys do some development financing, you do pref equity and mezz. So you're up and down, and primarily, as you said, multifamily. What attracted you to multifamily, versus other real estate sectors?
Well, at the end of the day, people need somewhere to live. And so, this pandemic is underscores that dramatically, but we also saw it in the great financial crisis. People don't have to go to the office. People don't have to go to the mall. People don't have to stay in a hotel. People have to live somewhere. So as it relates to the defendability of the sector, as it relates to all commercial real estate asset classes, has been the strongest. We have had perennially a very strong market position in multi, which has allowed us to continue to build in the multi space. But Darren, if you look at our servicing portfolio today, it is about the same as it relates to proportions of multifamily versus other commercial real estate asset classes. So 85% is multi and about 15% is non-multi. But if you look inside of those other asset classes and what the forbearance rates are, we don't take any risk on any loans outside of our multi-portfolio. So as I talk through these forbearance rates, these are all loans that we have originated for life insurance companies, banks, and CMBS lenders, where we don't take any risk, but the forbearance numbers would tell you where there are upcoming foreclosures coming. So in our hospitality portfolio, the loans that we service, over 70% of them are in forbearance today. If you look at our retail portfolio, over 40% of the loans on retail assets are in forbearance today. If you look at our office loans, 20% of the loans on office buildings are in forbearance today. If you look at our industrial loans, less than 2% are in forbearance today. And if you look at our multifamily portfolio, which, as I said, is 85% of our portfolio and is the only asset class that we take risk on, our forbearance levels are well below 1%. And in our Fannie Mae portfolio, it's below 0.5%. And so you just think about that in where's their liquidity in the markets, where's their value, and also where are people getting pinched, hospitality, retail, office, and where are people not getting pinched, industrial and multifamily. We feel very, very lucky to be positioned today with the portfolio we have and with the market presence we have in the multi space.
So you may indirectly have answered this question, but outside of multifamily, are there any other sectors that you like or are bullish on at all?
Well, I guess there are a couple things. First of all, I'm far more bullish on all of us returning into the office than many people. I was on a board call for a hospital that I sit on the board of yesterday, and we were talking about some office space that the hospital was thinking about taking, has a long-term lease on, and the president of the hospital was like, man, I just don't see us needing that office space anytime in the future. And I sort of asked the president of the office to take a pause for a moment and realize that we are going to get back to an office, and that the hospital is still going to have accounts receivable that need to be followed up on, and that they're still going to have diagnostic testing that needs to happen in an office environment, et cetera, et cetera. And so I think that many people have fled from office, retail, and hospitality. No surprise. I would say to you that, if you look at certain retail today, it's operating fantastically. I took one of my sons to a Chick-fil-A on Saturday, and it was 2 lines leading into the Chick-fil-A. They had 3 people outside taking orders remotely. I'm sure everyone on this call has seen this. And Chick-fil-A has been able to adapt to the COVID world, and I'm assuming that Chick-fil-A's sales are doing great business. That's still a retail food offering, right? They've just been able to adapt to the COVID world better than others. And so, I think you go long Chick-fil-A if it's still getting beat up as it relates to the overall downdraft on retail. I guess the other piece to it is that as much as everyone says that Amazon is taking over the world, I believe in Q2, total retail sales in the United States, 16% were online. 16% were online. That's still a percent of retail sales done in bricks and mortar. So while that's up from 10% in Q1, and fantastic growth for Walmart.com and Amazon and everybody else who went online, in a quarter where we were completely locked down, you still had 84% of retail sales happening through a bricks and mortar format. And so while clearly all the money on the capital markets has gone in the stock market has gone to Amazon and everybody else who's in the online world, there's still a tremendous amount that's going on in the bricks and mortar world that is going to continue to happen going forward. So I'm not in any way one of those people saying all those asset classes are dead. At the same time, I would also say that those are the places where there is going to be opportunity, and there's also going to be real pain.
Yeah. Our office, we are in the process of moving. We were going to take a 1.5 floors in our new space, and now we're only taking a floor. So, I think it's definitely given light to the ability for some folks really thriving at home versus not the commute. In my mind, when somebody would say, what's the safest real estate investment in the world a year ago? Well, of course, it's high-rise, New York office. Not today, right? So there's definitely many people I know that are shifting their patterns of work. And I guess it also depends on the geography that you're in, California, New York versus where we are in Colorado, much more open as well. digging in a little more on the multifamily side, I think there's a lot of perceptions and or misperceptions. I know we had an advisory board call a few weeks ago, and this came up, how the multifamily sector is really holding up. Maybe one of the misperceptions could be, C-class apartments, with the CARES Act having expired, et cetera. So kind of digging in, on that, how has multifamily held up during this downturn, and more specifically, rent collections? And within those rent collections, are you seeing degradation in A's, B's, or C's? Meaning C class.
So yeah, the sector has held up incredibly well beyond anyone's expectations. As has, by the way, the single family sector. I had Mark Zandi on the Walker webcast last week, and I was talking to Mark about a research paper that he and a bunch of really good economists did back in the depths of the pandemic back in April, where they had projected single family forbearance rates, and their models were 10%, 15%, and 20% of all single family mortgages would look for forbearance. And the single family mortgages hit a peak of 8.55% back in May, and it's been coming down ever since then. So even on the single family side, what we have seen has been much better than most had predicted. On the multi side, to give you a sense, as I said previously, our multi portfolio is extremely large, about $85 billion of loans. It's in every asset class in the sense of major MSA, secondary, tertiary markets. It's high rises, it's walk-ups, it's stick built, it's concrete, it's A's, B's, C's, and D's. It's 7,000 properties across the country. It's enormous. And right now, out of that 85 billion, we have less than 350 million of loans with Fannie Mae and less than 350 million of loans with Freddie Mac that are in forbearance today. And of the loans that took forbearance at the beginning of the pandemic, 91% of them are back paying current today, 91%. So unlike the single family world, where 75% of the loans that asked for forbearance in that 8.55% that had a 3-month forbearance period, 75% of them have asked for another forbearance period. They've asked for an additional 3 months and an extension. In our portfolio on the multi side, 91% took that first 3-month period and have come out and are back up paying. You may have seen, Darren, that the NMHC rent tracker, which everyone's been focused on, it covers 11 million apartment homes in the United States on a monthly basis. When they first put that out there back in April, I kind of screamed and yelled because they gave a mark after 6 days of the month of April. And I said, how can you tell anything by 6 days of the month of April? And it was down off of April of the previous year, and it was down from March. And so a lot of people kind of freaked out. But what we have seen on the rent tracker is through the month, collection levels of either full payments or partial payments have gotten up into the upper 90s, 95, 96%. The early days of the month have fallen precipitously, yet interestingly, for the first 6 days of October, we're back at pre-COVID collection numbers. For the first 6 days of October, I believe the number was 78% of payments were made on either a full or a partial payment, which is back better than the month of March, where the pandemic had not hit in. And so you're just seeing a tremendous amount of resiliency in multifamily rent rolls. We've now gone for August, September, and we're coming into October with no additional stimulus monies, no stepped up unemployment insurance benefits, no $1,200 stimulus checks, no $500 per dependent check, and we're still seeing people pay their rent. And so I think, there's a lot of question marks about how long people can continue to do that if we don't get a significant pickup in the employment numbers. The published numbers on unemployment, as you well know, Darren, have fallen below 8%. But if you look at really good economists talking about the number of people who have just stopped looking for a job and are 62 years old and just basically said, I'm done, that number is up precipitously, where you're actually looking at true unemployment numbers in sort of the 11 and 12% still today. And so the one thing I would caution people is that as you hear the published number by the Bureau of Labor Statistics of less than 8%, that's on a significantly reduced labor force of people who are out actually looking for jobs today. And we still have a significant amount of unemployment sitting out there today.
You know, it's interesting in our portfolio as well, we're actually collecting 103% of normal. Our occupancy's up year over year. You know, from a collection standpoint, feel really good. One of the things that we have, and good and bad, is we've noticed that our retention rates are much higher. People aren't as likely to move in certain areas. Where we're seeing a hit on the income side is other income. We're not seeing as many of the lease breakage fees and what have you. I'm curious on the expense side. You know, over the last couple of years, we've seen our insurance and taxes just surge, I mean, 100+%. What are you seeing, you know, in your portfolio on the expense side, and what gives you concern as far as the whole stack goes? Is it income, expense, a combination?
So the real focus right now, Darren, is rent rolls and trying to get a good view of where rent rolls are headed. We're doing a huge amount of refinancing business right now. We have earnings in 2 weeks, so I can't give you full clarity as it relates to the percentage of our business. Well, I can't give you the aggregate amount of volume that we did in Q3, but it's very robust on the multifamily side. And it's also the breakdown between refinancing and acquisition, whereas in Q2, acquisition financing basically fell off the table. We did tell investors in our Q2 call that we expected to do around $1 billion of multifamily investment sales in Q3. And with that $1 billion of investment sales in Q3, the split between acquisition financing and refi has come up. In other words, acquisition has become significantly more than just the refis. But the real issue right now is really focused on income and on how strong is that rent roll and what does the rent roll look like over the last 3 months. What we're finding is that rent rolls are kind of bouncing around a little bit. There are those properties that have sort of a bulletproof rent roll and have sat at 95, 96%. You just mentioned that, you know, we talked about it during your advisory group call last week, that you've got this just, you know, incredible performance in a very large part of your portfolio. And when you've got assets like that that are performing that well, you can get refinancing at scary low rates and full proceeds on the loans. What ends up happening is that when we see rent rolls falling from 95% economic occupancy down to 90 and down to 85% economic occupancy, we have a hard time underwriting what the future is going to look like there. And what we end up getting is sometimes instead of looking at a T3, we're looking sort of at a T1, and we're looking at kind of the worst T1. And so that's really, quite honestly, as we're looking at underwriting decisions right now, that's the real issue. Issues on taxes and on costs and retrofitting for the cost of COVID and all those other things really are, I mean, we're obviously looking at them, as you can imagine, Darren, but they're not really the focus right now. It's really trying to get some visibility on the revenue line.
Yeah. And so, you know, with the CARES Act, you know, having expired in the relative high unemployment rate, what are you seeing as far as rent collections within those different classes, Class A, B, and C? And is there a major difference? I think one of what I would say is the misperceptions I've heard from some folks is, hey, we're going to wait and see. Like you said at the beginning of the call, and it may sound like a very, you know, generalist comment, but if you don't have a roof over your head, you're homeless. And so housing, as we now have proven since I've started the business 19 years ago through 3 different downturns, housing is a necessity. Now, whether people have the capital or not, you know, the income or not to pay is really my question to you, you know, within the different classes. And are you seeing a degradation in those, you know, collections or not within those different classes?
So first thing I would say is that we are not a big lender on what I call brass and glass. So we do not have a lot of loans in our portfolio on a related property in downtown Manhattan. It's a 36-story Class A multifamily building that has seen significant degradation to their rent roll. So we just don't have a lot of that in our portfolio. That's not been where Walker Dunlop has been a big lender. We're much more on the, Class B garden style walk up in suburban Denver. And so, first of all, our portfolio is a little bit distinct from some of our competitors' portfolios as it relates to exposure to San Francisco, New York, Dallas, high rise downtown Chicago, high rise downtown Class A. Okay. So I know anecdotally, but not through our own portfolio, that those assets are struggling, and that there are a lot of people who have basically said, I'm a VP at Goldman Sachs. I'll keep picking on related, even though it might be a related building, it might be an EQR building, it might be a who's ever building. But I'm living in an apartment that cost me $15,000 a month. I'm located 5 blocks from the Goldman Sachs office, and I've loved walking to work. I don't have to go to the office anymore. My kids' school in Manhattan said that they weren't going back in the fall, and I want to kind of have my kids have a little bit more space in the backyard. So I'm going to go out and look in Greenwich, Connecticut, where I can buy a $2 million home. I've got the 20% down payment, and my mortgage rate on that $2 million loan, it's not even a $2 million loan after I put 20% down on it, is actually only $9,000 to $10,000 a month. So net, I'm ahead of the game, and I've got some more space. That's happened. That's like happened. It's like that person has already made the decision in June, and they are happily ensconced in Greenwich, Connecticut today. Okay. And so that's hit occupancy levels in that asset in downtown Manhattan. Clearly many of those buildings are owned by big institutional investors. They know the markets are going to come back, and I believe that they're not going to throw the keys back to the lender, but they are having a really, really tough time as it relates to their overall rent rolls. The second area that I would focus on is the suburban high rise, the suburban walk up. That has been very strong. If you look into our suburban portfolio, it's been fantastic. People want access to the out of doors. They like a walk up rather than the elevator buildings, and all of the rents have held up very, very strong, and occupancy has held up very strong. At the end of the day, this whole issue of suburban versus urban and single family versus multifamily, there are a number of people, including Ivy Zellman, who I think the world of, and Mark Zandi, who I think the world of, two extremely insightful people who have both been on the Walker webcast in the last 6 weeks, and have both come out and said, if I got to pick multi versus single, I'm going single all day. I'm actually not so convinced that they've got that right. I think without a doubt, if you had single family inventory in June, July, August, September, October, November, December, January, February, you are either sold out of it or you will sell out of it very soon. But I'm not so sure about all of the shovels that are going in the ground right now for new deliveries of single family that will arrive in July through February of 2021. Because there are two big issues that are also happening right now. Three, I guess. The first is that anyone who has a single family mortgage has already gone on interest rates. So 30 years, and it's the cheapest financing ever gonna. They've all done, in many instances, cash out refinancings on their homes. They put a lot of money in their pocket, and they have an incredibly low interest rate going forward. That says, hey, I'm in a really good spot as it relates to my financing. The second thing is they've all gone to Home Depot and they bought lumber for a new backyard porch. They bought a can of paint to put a new fresh paint on the guest room. They've gone and made a home office for themselves out of the storage space in the gym. So they've been investing in that home. So to turn around and have the lowest interest rate they're ever going to see, and also having made an investment on the home, to then leave that and go move somewhere else, I just don't know that there's going to be a lot of churn in the single family markets. And so then it's multifamily to single family. And at the end of the day, we are in an economic recession at best, potentially depression. And we've had a huge amount of federal stimulus to get us through this. But at the end of the day, we have an economy that is still in a really bad spot. And that just means that people aren't going to have money who are renters today to turn around tomorrow and go be a homeowner. Yes, that Goldman Sachs vice president has already moved to Greenwich. Forget about him or her. But as it relates to the person who lives in one of your apartment buildings, Darren, he or she is not going to be fundamentally different from an economic outlook 6 months from now or now than they are today. And as a result of that, they're not going to be able to buy that single family home that single family home builder is building today for delivery in July or February of next year. And so I'm actually quite bearish on the delivery of new single family housing. And I think that we will see continued strength in multi for all of those three reasons.
I appreciate that. About 2 years ago, on the development side, we started pivoting from more of the infill, what I call the urban suburban. We were that first ring. We were building more high density product, really started, looking out another ring or two in that suburban product where we started seeing demand. And I think a lot of the institutions were really focused on those urban cores in those, larger, say, coastal, or I could even take, downtown Denver, where the focus was, hey, construction costs are going up, steel, concrete, et cetera, and we need higher rents. I think at some level, people started getting priced out of those markets or said, hey, I like these kind of nodes where there still is shopping, food and walking as they start having more family formations. So we too have been following the same thing. When it comes to like the different segments of multifamily, we at Forum a couple of years ago started really targeting what I call the missing middle class. In Colorado, it's somebody that makes $35,000, say, to $80,000 a year. They make a little bit too much to, qualify for any federal or state assistance, and too much, or I should really say not enough to have to buy a home. With the lack of assistance out there today, and in my mind, redefining, what truly affordable is, both as a lender, Fannie, Freddie, it used to be LIHTC was affordable. Now it's at 51% of your units or at 80% of AMI, not, 60 or lower. That's affordable. What are you kind of seeing? What's your outlook for this missing middle class, as we call it?
So it's a huge demographic, Darren. It's a demographic that needs safe and affordable housing, and there isn't enough supply of it. We're right now undersupplied in multifamily per Peter Linneman's most recent forecast by about 1 million multifamily units. Most of those million that are missing are affordable housing exactly that you're talking about, that is affordable to that demographic. The unfortunate reality of the great financial crisis into the COVID crisis is that owners of assets are seeing the value of those assets inflate, and those people who rely on take-home income are standing still. And we have seen in the last couple of years, those people at the, if you will, the bottom rung of the earning bell curve starting to move up and seeing some really significant improvements at the lower levels as it relates to actually wage growth and income growth. But as we all know, it's not coming fast enough, and it's not going to make a difference in where and how. And so creating housing that demographics needs from an affordability standpoint, from a safety standpoint, and from a usability standpoint is an incredible market. It's where the regulator has Fannie and Freddie very focused right now. And HUD has sort of always been focused there. And so, you have the three largest providers of capital to the multifamily sector, all focused on affordable and workforce housing. And as such, if you're building product or buying product, meaning at that price point, you're going to have access to the very cheapest debt financing out there.
So kind of switching gears, putting on your investor hat for a minute, are there any, particular geographies throughout the U.S. that you're, more excited about, as an investor than not? And can you share why?
I don't know if I have a whole lot of, good insight here, Darren. I would put forth to you that the one thing that I would caution people not to do is to look at Q3 2020 and make any assumptions about the next 5 years based off of Q3 2020. So we're at a time right now with a huge amount of uncertainty. We don't know when we're going to have a for this virus and therefore the end to this pandemic. We don't know who the next president of the United States is going to be. We don't know when we're going to have a stimulus bill that helps push this economy forward. And on those three things alone, if you start knocking those down, which you're going to start doing in the next 3 weeks, you're going to know who the next president's going to be. You're going to get a good sense of when the next stimulus bill is going to be. You're going to get a better clarity on, does the J&J suspension of their trial yesterday mean that we're not going to get a vaccine sometime soon? Or is that actually someone who was in the placebo who just got sick with another flu and they get back on track? The thing I'm trying to say is that there's so much uncertainty right now that it's very, very difficult to make bold predictions. But we're going to get more clarity in the next couple weeks and months. And as it relates to broader themes, there is no doubt that this pandemic has put state and local governments in a really bad spot. And state and local governments are going to need to raise revenues. And as a result of that, they're all going to start looking for tax revenues. They're going to all try to figure out how they can raise revenues to be able to pay for all of the things that they've either missed from a revenue standpoint during COVID, or the incremental cost of doing business that's come in from. So states are going to get higher, and low tax states are going to get higher, but relatively speaking, are going to be looked at, I believe, much more favorably. So it's not, this is no newsflash to anybody on this. Where we're seeing a lot of activity on the multifamily side is in the lower tax states. It's in Florida. It's in Tennessee. It's in Texas. It's in Colorado. What you're also seeing is, on top of that, that's where jobs are moving, except you can't really follow corporate headquarter relocations as an indicative, as some kind of indication of where where people are going to live, because, companies will move to Texas, but they don't necessarily bring all their employees with them right now, because Microsoft just talked about having employees potentially work remote indefinitely. So I think that that's one of the other things that's important to keep in mind. I also believe that you're going to get some false positives here. So for instance, we have a worker at Walker & Dunlop who works in our New York office. He's living in Boise, Idaho today. He will not be working and living in Boise, Idaho the day that it is safe for him to go back into our New York office. And I and the person who runs our New York office says, you need to get back to New York and get back into the office. So he's a false positive as it relates to the strength of the Boise rental market, because he's renting in Boise, Idaho today, but he ain't going to be renting in Boise in a year from now, or hopefully not a year, and at outside, probably no way he's renting there in 2 years. So I think the other thing to make sure that people are understanding of is that there are a lot of people right now in this work environment that are living in places that they will not be living in long term. I like to focus on things like schools and cultural institutions. There's a great school in Manhattan called Dalton. Dalton is a unique school that thousands and thousands of people would love their kid to go to, because Dalton has an incredible college acceptance. To the best of my knowledge, there is no Dalton in Boise, Idaho. So that Walker & Dunlop employee who's now living in Boise may say, I love the out of doors and I love the access to, walks in my dog park and all that kind of stuff. But when he starts to have a family and he's thinking about the education of his kid, and I'm not trying to knock the Boise, Idaho education system, but they don't have a Dalton. And so if you want a Dalton, you got to be in Manhattan. If you want access to the Metropolitan Museum of Art, you got to be in Manhattan. And so there are just certain things that I think a lot of people have discounted the value of in major cities that humans haven't forgotten about and haven't all of a sudden forgotten a taste for them. It's just they can't use them today, but they will come back in value, and people will want to live close to them in the future.
Got it. Just a quick follow-up. So are there any markets that you're afraid of? I know on the advisory board said you were seeing some pain or just not seeing positive things in some of the coastal markets. Is that still a fair comment?
Yeah, it's very much a fair comment. Look, I have tried, as you well know, Darren, to stay 1,000 miles away from politics since I've been doing the Walker Weekly webcast. And even trying to be as agnostic as I possibly can be, I still get emails from the left and the right saying, "Oh, you're promoting this or you're promoting that." So I'm not in any way trying to make this a political statement, but you can't help but look at the economic activity that is taking place in certain states that opened up quickly and other states that have stayed locked down longer, and see what that has done to, there was an article last week in the Wall Street Journal about a guy who owns 2 pizza restaurants, both one's next to Disneyland, one's next to Disney World. And so the one in Disneyland, which is still shut down after 200 days since California shut it down, his sales in his pizza joint, he's not on campus, if you will, at Disneyland. He's outside of Disneyland, so he's still operating, but his sales are up 90%. 90%. He also has a pizza joint that's outside of Disney World, which Disney World is open, but only for 25% occupancy, but it's open. And his sales in that one are off 30%. So you have one pizza parlor that actually is shut down, because we all know a pizza parlor can't survive on 10% of normal revenues. But the other one has a fighting shot of surviving because it's only off percent. And so one of the things that I do think is very important is that there are certain states that are holding back on opening up. I think you and I have the greatest, we're fortunate, we're in a purple state. I think the government of Colorado has dealt with this perfectly, and it is, I believe, truly due to the politics. You basically have, if you will, and again, I'm making broad generalizations, but you have more of a blue view to wearing masks and protecting yourself, and you have more of a red view to opening things back up and allowing people to actually do commerce. And that combination of blue and red in Colorado has kept infection rates low enough so that commerce can keep going. Yet on the red side, it's gotten commerce back up and going. It's been a great mix. I would say to you, you look at some of the deeper red states, their infection rates are at problematic levels now, but their economies are back up and going. And then you look at a number of blue states that are still shut down, their infection rates are very low, but they have no economic activity. So I do think that there's a happy medium here. And it's unfortunate that certain rent rolls reflect what has happened in those states. So the place that we have the most degradation to rent rolls, Southern California. Period, end of statement. It's just, it is the problem spot. And you talk to owner operators, particularly in the LA County, and that is, it's not only is the government not open back up, there's a big free rent movement, and there's a lot of activism as it relates to free rent and not paying your rent. So that has caused all sorts of problems in Southern California. New York is obviously another one that's had real issues. And then there's sort of everything in between. The final thing I'd say on all this, Darren, is we are now heading back into the second wave, if you don't believe that the spike that we saw in June and July is the second wave. And the virus is going all over the place into states that kind of lock down and into states that are more open, et cetera, et cetera. And I am very fearful that we have a second wave that makes it so that things have to start to tighten down, slow down, and shut down. And it's just my great hope that every American, regardless of your politics, takes their role in making sure this thing doesn't spread by social distancing, wearing masks, and making it purely from an economic standpoint. I don't care about the politics of it. Purely from an economic standpoint, if we all do our part to try and keep the infection rates low, that will allow for restaurants to stay open, for Home Depot to stay open, for Starbucks to stay open, and for all of us to start to get back to some normalcy of life. And at the end of the day, I think that that's the most important piece to all of this. Because if we get a prolonged recession, we are going to have really damage to a lot more significant pain and suffering than quote unquote just the virus, which obviously has had a devastating effect on the health of the American population.
Oh, very well said. We're coming up on 5 minutes left. I want to ask you one more question. I want to get into a personal question for you as well. So some of the listeners on this call, are new to commercial real estate and to the multifamily space. If you just take a second, like from a 10,000 foot view, like why should multifamily be part of somebody's portfolio? And, is now the time to be getting into multifamily when we have historically low interest rates, yet we also have historically low returns as those interest rates have come down?
So we're in a yield-starved world, Darren. Period. End of statement. We're in a corporate dividends are down. The amount of money that people are making off of government bonds, corporate bonds. We're in a yield-starved world, and that yield starvation makes it so that it is very difficult for people to find investments that are going to return to them any kind of current income. And so as a result of that, those types of investments, such as multifamily, that do steady, stable returns, albeit in comparison to were 10 years ago, relative to treasuries and corporate and corporate dividend payments, it's a fantastic return. And so what it's going to do is, what people will continue to see is that on a relative return basis, it's a fantastic yield. And then because it's a fantastic yield on a relative return basis, people are going to want to own those properties more, which is going to push cap rates down and values up. And so it's that virtuous cycle, if you will, as it relates to being in a yield-starved world and multifamily being the most stable commercial real estate asset class, with a yield that is relatively higher than what you're going to get off of dividends or corporate debt or government debt, which makes it so that people want to invest in those types of properties. When the investment income comes for that return, cap rates go down, values go up, and that makes multifamily a good long-term investment from a value standpoint. So I see that as bright as I've ever seen it. The real question that I have right now is whether low interest rates or capital is what drives cap rate compression in multifamily. And by that, I mean that everyone looks at the risk-free rate. You look at the spread between the risk-free rate and what people would be buying commercial real estate at from a cap rate standpoint, or more generally, what's your cost of financing, and add about 200 basis points, and that should be where the cap rate is, relatively speaking. So if you go back 10 years, cost of capital was at 4.5% to 5.5%, and you were buying multifamily properties at somewhere between a 6.5% and a 7.5% cap rate. As the cost of financing has gone from 4.5% to 5.5% down to 2.5% to 3.5%, cap rates have compressed down to 4.5% to 5.5%, and even below that. That's a back of the envelope cost of capital and what kind of spread you ought to be getting on your cap rate. But at the end of the day, one of the reasons why multi is distinct from other commercial real estates, and why that association of cost of capital with cap rate somewhat dislodges, is because of the role the federal government plays in financing multifamily properties. And because Fannie, Freddie, and HUD provide so much liquidity to the sector, if you really watch cap rates, it's actually the amount of capital available from an equity capital and from a debt capital standpoint that is a clearer driver of value. And so what you're seeing now is the non-multifamily commercial real estate asset classes are deprived of capital from both an equity and from a debt standpoint. That's going to make cap rates float up and values go down in non-multi. Multi has a huge amount of equity capital and a huge amount of debt capital, and that's going to drive cap rates down if you look at past cycles.
Well, we're just you could not you and I could not be more aligned on that. I've been saying for years, we're in a yield-starved world, and we have 7 countries now with negative interest rates, and as our taxes do go up, as you mentioned, there's no way they won't, with the lack of sales tax revenue and just other revenues for the municipalities. People are in a yield-starved world, but also need a tax shelter as well. And then when you look at commercial real estate, as we've discussed, multifamily and industrial are kind of the 2 darlings of the ball here. Just because we are up on time, I do have to ask, as we come to an end, the audience knows a little bit about you on the business side, but you actually ran the Boston Marathon and finished in 2 hours and 36 minutes. I know you're doing rehab right now. If you would just take 1 minute so we don't keep people too long, tell us a little bit about that day and how hard the training was that went into that.
Oh, Aaron. So, well, because I'm going into PT, the idea that I can even run a 2:36 marathon is hard to even get my arms around. I will say this one thing, which is it has to do. It's relative to business because it talks about alpha and how you get outperformance and how Forum gets outperformance and what the difference between good performance and great performance is. The year before I ran my 2:36, I ran a 2:45 Boston. And I thought I'd hung the moon running a 2:45, but I was convinced that I could run faster. And I will just tell you that the difference in my training program and the intensity of my workouts to go from a 2:45 to a 2:36 and take 9 minutes off my time was on such an order of magnitude that's hard for me. I could describe it to you for half an hour, but I'm not going to bore all of the people. But what I'm trying to say here is this, that 9 minutes, while it doesn't sound in the aggregate like that much, when you get to a 2:45 marathon time and you want to take it up that much more, we all know that incremental performance level is what differentiates good from great. And what it requires is being the type of owner operator that you and Forum have been. What it requires is having the people and the process and the systems like a company like Walker and Dunlop has that allows us to consistently outperform. And so as I look back on that marathon and what it required over that 1 year, it wasn't that I just ate a little bit better the night before. It wasn't that I sort of had a different training partner. There were so many things that had to come together into creating that performance on that day. And it's all that sort of hedgehog strategy of just do it every single, a little bit harder, change the program, and the performance will follow. So it does feel like eons ago. It was a great day. One thing I certainly know, Darren, is I could never do it again.
You're a true warrior. Well, just to wrap it up, I'd like to thank everybody that joined today, and thank you, Willy, for making the time to talk with us. Your insights are invaluable for us. So thank you so much. If we didn't get your questions, I tried to add some of the questions into some of the things that Willy and I spoke to. We will have a follow-up to this presentation and try and address some of those as well. So thanks so much to everybody. Willy, thanks again.
My pleasure, Darren. Take care, buddy.
Take care.